Thanks for tuning into Talking Point. I'm your host, Niraj Shah. With the Bank Nifty having eclipsed its previous highs, we now have all the key indices in India trading into uncharted territories. But the key point is, with the globe and the Indian market so tightly intertwined, what are the factors that could influence what the markets do in the near term, aside of course, our own earnings season and the union budget coming up? Let's talk about all of that. Excuse me. Let's talk about all of that with Mr. Vetri Subramaniam. He joins in right now to talk about his thoughts on how he feels about the markets and investing in the current juncture. Vetri, good having you. Thanks so much for joining in. Hope all is safe.
Good morning, Niraj. Yeah, good to be here. This is the first conversation of 2021. Touchwood, things have been good, and yeah, we'll just have to keep praying for the best. Thankfully, there is visibility of a vaccine now, so hopefully, life goes somewhere back to what we all used to consider the normal.
Yeah, yeah, indeed. Hopefully soon enough. Actually, let me start with that then. We have the vaccine visibility, but we also have this re-emergence of fairly stringent lockdowns, not in India, but the other parts of the world. Um, could the impact on financial markets be different than what it was in April, May, simply because we have the vaccine visibility?
So, in a sense, I think the behavior of markets, in a sense, is a reply to that question in its own right, Neeraj. If you look at the UK markets, this news about the whatever I've lost count, third or fourth lockdown that they went into somewhere in the middle of December, the market greeted that by rising to a new, post-COVID high. And if you look at the US, you would actually argue that they've just had one long rising curve without any lockdown for a very long time. But the market has just continued to power higher and higher. So in that sense, it is quite incredible that, even in economies and markets where there have clearly been setbacks, the markets have actually continued to rally. And certainly, without doubt, this is both a function of the significant fiscal firepower that some of these economies have injected, governments have injected, and of course, the significant liquidity wave which has been created by central banks, which continues to paper over these fears of a setback to growth related to the lockdown. And of course, the visibility of the vaccine is helping investors think about what things will look like 6 months later rather than worrying about the short term challenges of the lockdown. So it would certainly appear that even economies and markets which have faced a challenge from the resurgence of the virus, the markets have not really seen a setback at all.
Yeah, they haven't. And you reckon that would be the case? I mean, India, of course, has not had it's very curious, Vetri, that our cases are actually moving down so swiftly. Yesterday, I don't have today's number, but yesterday we were very low cases. The mortality rate was sub 200. So we are doing something quite dramatically different than the rest of the world, almost the entire rest of the world, because even China is seeing re-emergence of lockdowns and rising cases. Of all debts are bad. But I'm just wondering, purely from a relative case, is India therefore looking like smelling like roses, or you don't think investors globally and India will look at it that way?
It's not clear to me. I don't think even the doctors and the epidemiologists really have the answer at this point of time as to why India's curve has behaved the way it has. But touch wood, as somebody once said, "Ye desh Bhagwan bharose chalti hai." I'm a much bigger believer in God today than I ever was, simply because India seems to have navigated it well. Of course, we were also, remember, one of the countries that chose one of the most stringent lockdowns very early in March. So maybe that also contributed. But, that's all for the history books that will be written a few years from now as to what worked in our favor and didn't. But I think safe to say right now, we are in a happy situation. Yes, you're right. Any loss of life is something that saddens us, but we are navigating it much better, and we just have to keep our fingers crossed that with the vaccine being available, things can get back as close to normal as we used to experience. It's not very clear to me, Niraj, that this is causing investors to look at India any differently compared to the way they are looking at other geographies. Many of the conversations that we've had in December, not this month, but in December and November, investors were still trying to, get their hands around the recovery, not focus so much on, is India necessarily doing better than other geographies when it comes to the virus. So I don't know if that's really playing, I would say it's not really playing a big role in the thought process of investors. And I know people talk about the fact that there's a significant foreign inflow into India. Without doubt, of course there is. But this is a wall of liquidity coming from all over the world. And the counter to that is that you've actually had domestic investors take money out of equity. So are you saying foreigners are more bullish that we've overcome the virus and locals are more pessimistic that we've not overcome the virus? I mean, these are just narratives based on one data points. I think just touch wood, we are in a good place, and hopefully we can execute and get the economy onto much stronger trajectory going ahead.
Yeah, that chart beautifully shows you, isn't it? I mean, if just viewers look at the chart, that just shows you how India is compared to the world, and how our 14-day changes are much, much better than almost any other large nation, as you can see, be it Brazil, Russia, UK, France, or US. India is doing, touchwood, really, really well. We hope that the whole world does really well, but on a relative basis, yes, it's very interesting what India is doing. Nevertheless, Vetri, you draw up a very important point. I want to ask you that what's happening with these fund outflows? I mean, is your assessment also that people who are taking the money out are essentially parking them directly into equities? And what is it that you have experienced? Because from whatever little I understand, your schemes have done well. Have you also still experienced large, on a relative basis, larger uh, withdrawals from your sets of investors? And if so, uh, part two of my question then would actually, let's get done with part one, then I'll get to part two. What is your assessment and what has been your experience at UTI AMC when it comes to flows?
Uh, yeah, Neeraj, so I'll just start with, our experience. So I would say, Touchwood, the team, the process, we've come together quite well over the last few years. So performance has stayed strong through 2020. But when I look at the data, we've also certainly experienced the pressure of, investors looking to take money out of equity. Better than the industry trend, but certainly we've experienced that pressure as well. We launched a small cap fund in December, so that contributed in a significant way to inflows. But when I look at the aggregate data, there is pressure. We are seeing outflows better than industry, but that's been there. It's very hard to put a finger on, why this is happening, but I'd have to go back to my own experience, going back almost 20 plus years in this industry. And it's not the first time we've seen this pattern where when you see large numbers of retail investors coming into the market and then the market experiences a very sharp decline, the first reaction of many investors when it recovers is actually to start taking money out. It's really more behavioral in that sense. And I'm not surprised to see this, even way back in 2001, 2003, this was the same pattern that we saw. The markets had sold off, and as they started to recover, the first response of many investors was that, let's redeem. Having said that, I am sort of encouraged by the fact that the SIP flows have largely held up. They've not experienced a dramatic decline. I think what's also happened is there's been some amount of reshuffling that's happened. Investors perhaps exiting certain schemes and transferring money into schemes or managers where they have greater level of confidence. But I think it's largely a behavioral impact. The second point that I would make is that, remember, I think for a lot of small businessmen, for a lot of people, the visibility of income was a very, very big challenge when we got into the lockdown. And of course, therefore, they had to access some of their liquid assets to make sure that they could meet their liabilities, they could keep their businesses functioning. And perhaps nobody was very clear at that point of time as to when we would get back to some level of normal functioning. So anecdotally, certainly feedback from a lot of IFAs, etc., that we have is that investors have withdrawn money also to sort of help them meet perhaps pressures that they are facing, either because of a reduction in salary income or because their businesses need it. But given that the economy is pretty much back up to normal speed, I am hoping that some of these withdrawals will actually slow down. And to the extent that we're actually seeing that a lot of the data for the banks in terms of credit, remember 6 months back we were all very worried about how bad this entire lockdown and COVID impact would be on banks in terms of NPAs. And certainly our worst case fears look like they are no longer materializing. Things are much better than expected. So maybe some of these withdrawals have also provided a buffer to individuals and businesses during what is a challenging period for cash flows. So it's a combination of things. Hard to put my finger on just one reason and say this is the only reason.
Okay. Let's talk about part two of my question, and therefore that is that how bullish are you on equities? And yeah, combined out there is this question that if you indeed have to manage this withdrawal pressure, where is it that you guys are taking some chips off the table? Forcibly, I might add, because you have had to. I mean, if given a choice, you might have wanted to stay on, but because some of this happens, you probably choose um, the least whatever common denominator wherein you expect the uptick to happen. What's your stance on both of these?
Sure. So, just on the second part, um, let me just reverse that, Neeraj. I think in terms of the valuations itself, there is no doubt anymore that valuations have actually entered the expensive territory. I think pretty much through the last 6 or 9 months, I've been articulating that there's no point looking at the P. It's unfortunately completely skewed by the lockdown. Better to look at the price to book. But the reality is that given what's happened, I would say post November, even the price to book ratio for the Nifty 50 has actually now entered expensive territory. So I think clearly from a valuation perspective, there is today, real and live concerns in the market. As you drill down into the marketplace, let's say you look at the breakup between large caps, mid caps, and small caps, we do find that the valuation metrics for mid caps and small caps slightly more supportive than they are for the large caps. Secondly, there's one message that you get from aggregate market valuations, and there's another message that you get when you break up and start looking at individual stocks. I must say that in a lot of the cyclical areas, there is in fact still a fair degree of valuation comfort that we have in certain stocks and certain sectors. But if you ask me from an asset allocation perspective, clearly I would say you're certainly amber, if not now clearly into red, because even based on price to book, you are in expensive territory. Now what are we doing when we're obviously seeing some of this redemption pressure? Actually there are two tactics over there, Neeraj. One is really to say that at some level we are quite happy with the portfolios that we run, and I say this with the knowledge that our portfolio turnover ratios for a host of strategies has stayed at 15 to 20%, which is our long-term average, even through the last 1 year. And to the extent that we are happy with the portfolios and the way they have shaped up, we've not really tried to very aggressively reorient or change the portfolio structure because we are having to take money off the table. We've sort of perhaps just proportionately gone across the board rather than take very big calls. But the areas where we've tended to sort of hold our positions, some of the areas that we've liked, which benefited us in 2020, these are areas like pharmaceuticals, IT, strong balance sheets, globally comparative businesses, earnings trajectory looking strong. So we've been happy to hold on to that. Financials, a lot more challenging. Because I do think there is a separation which is happening over there between the stronger players who've got extremely high capital adequacy ratios, NPAs that look to be under control, and they've preemptively provided for challenges that could come through on the credit side. So we've been a little bit more cautious on financials, but even within that, certain financial institutions we've been willing to back quite aggressively. So financials would be the place where I would say largely underweight in the sector, but some of those names we are backing very, very strongly, because we do think that these institutions will most probably put their foot on the pedal and gain significant market share as we exit this COVID related setback. They've got their house in order, they've preemptively provided, and you may actually start to see the buffer come in very handy, and they'll be able to grow because they've got the trust of depositors and they've got the trust of the bond markets. So it's a slightly schizophrenic view in financials, but we think that's the way to go.
What about cyclicals, Vetri? You mentioned that there is valuation comfort there. We're seeing um, autos being the center stage of all attention right now, and the commentary from some of the OEMs as well as the suppliers seems to be that both globally and locally, despite the lockdowns, the mood is a lot more sanguine. Do you reckon that, coupled with the valuation comfort, means that autos is a pocket where investors can make money? Are you guys overweight relatively on autos?
Uh, Niraj, so we've been in autos for a while simply because we always liked the fact that many of these companies were high ROC companies. They actually, Indian auto companies are unique in the sense that they also throw up a large amount of free cash flow. And from our point of view, the slowdown in auto was already 2 years old when we actually got to COVID. And what COVID did was really completely clean up the inventory in the industry. So we've had overweight positions across a range of the four-wheeler companies, the two-wheeler companies, tractors, and quite a few of our portfolios have benefited significantly from the upturn that's been in auto. We're continuing to hold on to those positions simply because we think the structural story in auto remains very, very strong in terms of under-penetration. COVID has most probably given a leg up in terms of people choosing to allocate their expenses towards having their own personal mobility options. And finally, because of the inventory clean down, which happened, in late 2020, and then because of COVID, companies are actually now seeing a rising trajectory of output. So we think the sector is still very well placed for growth and continues to be one of our favored areas. Having said that, I'd also point out that, at UTI, one of the things that we do, Neeraj, is we don't run things with a one-size-fits-all approach. So there are very different strategies. You might find portfolio strategies or weightages looking different across strategies. But auto is one of those where I'd say there is a fair degree of overweight positions across a range of strategies, though the names that are overweight might differ between portfolio managers.
Can imagine. Last couple of questions, Vetri. What about commodities? They seem to have found favor until now with the economies opening up theme, but certainly not economies are opening up. In fact, for now, they seem to be in a temporary lockdown scenario. So I think Germany yesterday said that they might extend the lockdowns till maybe mid-April, which is, I mean, we may think that it is just now and the vaccine thing is there, but for 2 months, if the economy shut down, that's quite an impact. Do you reckon there could be uh, tactical pullbacks of sorts? I know you guys are not into trading, but I'm just trying to understand that if you get fresh bouts of money, would you wait for tactically better opportunities in the commodity space, or would you reckon that the cycle is so strong that you're comfortable even now?
So, Neeraj, first of all, as a thought process at UTI, we're very clear we're not in the business of taking cash calls. So we run our portfolios fully invested at all points of time. We'll most probably continue to allocate into the existing portfolio. But at the margin, when we have inflows, we can use those inflows to accentuate where we think there are opportunities. Now, our more sort of strategies which have a value-oriented tilt did have significant exposure to some of the commodity companies, particularly in the metal space. So we're quite happy with the way that's played out. The challenge for us in the metal space has actually not been so much the P&L of the companies, it's been the balance sheet of the companies. Too many of the Indian companies actually have balance sheet related challenges in terms of high overload of debt. But where we were able to, get in with some degree of conviction that we thought either the balance sheet or perhaps more importantly, the promoters were strong enough to see the company through difficult times, we've been happy to stay invested. And the beauty of, having commodity companies in your portfolio, which actually have some debt in them, is that when you actually start to see strong profitability, the debt starts to get paid down, and there's actually a increase in market cap, because remember, overall enterprise value has to stay the same. So we're actually seeing a significant tailwind in commodity stocks, not just because prices themselves are very, very strong, but equally because cash flow generation is extremely strong. Debt is going to get paid down very significantly in the next year and a half, and all those gains will actually accrue to the equity shareholders because debt is getting paid down, and that adds to market cap. So both those trends are quite strong in metals. We tend to stay invested in metals at this point of time. Maybe not add right away, but we're certainly holding on to our positions. And as I said, we'll stick with those names where we have some comfort that the entrepreneurs behind the company have the ability to navigate a difficult period, simply because their debt ratios are not really at the level we'd historically be very comfortable with.
Vetri, final question. Amidst all of this bullish sentiment, and I take it that you were largely constructive on equities, where is it that you believe things might not shape up as per plan? Because almost every sector has some tailwind going for it right now, right? But I think of any sector right now, it has got some tailwind. All can't be winners. So I'm just trying to figure out relatively, where do you think things might not be as great?
So good question, Niraj. And I always tell people, I've learned this the hard way. The biggest risks are the risks that you don't even know existed, right? And this goes back to whether it was the GFC in 2008, whether it was the policy paralysis and taper tantrum of 2012, 2013. Who knew demon would happen? That would be a setback to the market. Who knew that COVID would happen? So really, there's no way to predict what it is that eventually becomes a significant setback to the market. It typically comes from outside your range of vision. And I think the only way to navigate that, once again, Neeraj, is to have a portfolio. And I don't use this lightly to say that it is pandemic proof or whatever, but it goes back to simple basics. Companies which have high return on capital and strong operating cash flows, and in many cases if they generate free cash flow, even better, those are the ones which are eventually able to navigate a difficult period and have the optionality of hitting the flooring the pedal to the floor when the option for the economy to revive starts to become a lot more visible. So that really is the only way to prepare your portfolio for difficult times. There really is no other way. Within the overall context of the portfolio, you don't need to prepare every company for that, but you want to have a large part of your portfolio aligned towards companies which can navigate difficult times. I don't know what the next crisis will be. And I'm sure, given that there is a significant global trend which is driving markets across the world, this is not unique to India. You and I chatted about the fact that India is doing well on the virus front, but let's face it, even countries that are not doing on the virus front are, experiencing a rising and a strong stock market. So to my mind, that global trend and anything which causes it to reverse would certainly remain a live risk. But do I have a way to, articulate that in my portfolio? The answer is no. The best way is to have strong companies in the portfolio, and those companies and entrepreneurs will manage the challenging macro if and when it were to happen.
Fair call, Vetri. Let's wait and watch. No point, I think, preempting what is not there right now. But thank you so much for taking the time out and speaking to us, and have a wonderful 2021.
Sure. Thank you, Niraj. Great to chat with you today. Thank you so much.
Likewise. Really appreciate your time. And viewers, thanks for tuning into this leg of the Talking Point.